Okay, good morning and welcome back everyone to our Tuesday morning market outlook. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And we're starting off today on a pretty positive note. The markets are up at about 273 right now. Pre-market looks like we're going to open up right around that major support, major resistance level that we've been talking about for quite a few weeks. So really looking forward to see what we have in store here today. So let's go ahead and get started. Markets clearly are a little higher based on the optimism right now of the coronavirus. And just a quick disclaimer, what we're going to discuss here today is purely for educational purposes and a demonstration and not a solicitation to buy or sell any specific securities. So like I said, markets are currently in a fairly positive and optimistic tone after a very strong day, up about 6% yesterday, on the fact that it looked like in the US, we may have peaked in terms of number of new cases and number of deaths on Saturday. So we've had 2 full days now, Sunday and Monday, where the number of new cases and the number of new deaths have not exceeded Saturday's peak. Now, I will warn people that 1 or 2 days does not make a trend. We saw this in Italy, where we did see a couple of days of declines, and then it continued to move higher for quite a few days after that. There is still the possibility of that, and I see that if that happens, I think that the markets will sell off. But right now, we're pushing just around that 273 level, which is a level that we've been talking about for quite some time. I've been mentioning the 273 level as a major resistance level that I think if we hit that level, we're likely going to bounce off of it. Overnight, we did manage to get above 273 multiple times. Futures traded above it, but we're still currently opening up right around 273. So I expect quite a bit of selling going into that 273 level. But we did manage to push yesterday above the 20-day moving average on the daily chart. The hourly chart, also that momentum divergence has seemed to resolve itself. So going up to that 273 level, very interesting to see how the markets react to that today. If we are able to push above 273 in any meaningful way, that certainly puts us in a much more bullish outlook in the markets, whereas opposed to if we stay below 273, I would still expect more of a range-bound motion between 273 and 235. I will say that if we do see a peak in the number of coronavirus cases for 3 days in a row, that would put the outlook of revisiting 235 a slightly lower probability of us revisiting 235. But I want to show you some of the data that we're looking at here today. Oil certainly has recovered quite a bit, or at least it has stabilized, and I think we have formed the bottom here on oil. Crude trading at about 26, Brent at 33 right now, so that spread also coming a little lower, which I think is good for stability here. But still keep in mind that energy companies, most energy companies here in the US, especially the smaller players here, cannot bring oil out at 26 bucks a gallon and be profitable. So those companies will continue to struggle, and that's going to put downside pressure on the S&P earnings, because energy is still 6% of the S&P 500. We expect to see some bankruptcies in that space. We've already seen one already. And we continue to see that as one of the challenges for getting us back on our feet. The VIX, term structure is, again, we talked about this on Friday, where the VIX term structure just almost got out of backwardation, but it seems like it's still currently backward. I may be expecting that today is the day that the front month VIX, which is currently trading at 44, goes below the 3-month VIX, which is currently at 43. If the front month VIX gets below the 3-month VIX, then I would say that we are more in a risk-on environment rather than right now where we're still in this kind of risk-off environment. But again, we're just at that tipping point on multiple things. We're on the tipping point at 273 as resistance, and we're at the tipping point from a VIX volatility perspective. So certainly, again, a lot more positive news this week than we saw even going into Friday's open. So let's take a look. The coronavirus data, this is data we've been looking at for quite some time now. Italy peaked here around April 1st or so. They've had, this is Spain. Spain has seen declines over the last 5 days, which is encouraging. And the question is whether or not here in the US we're going to see the same thing. But as you can see, we've had multiple times, where for 2 days in a row we did not peak. But right now, that's what we're currently seeing. And the question is whether or not in the US we're going to see another day that looks it's below the peak or above the peak. And I think that's going to be one of the most sensitive indicators to look at for our market outlook over the next week or so. Looks like we're pushing again above 273. We've made multiple push pre-market above 273 each time it's been rejected. So interesting to see here in the next 25 minutes how the markets open here. But again, this is really part of what's driven this rally here in the markets, is the fact that we have had 2 consecutive days below the peak that we had on Saturday. So very, very, watching that data set very, very closely, because I think that's going to give us a lot of indications as to the duration of our lockdown, the duration of the economic impact that we're trying to measure right now. If we did have that peak on April 1st, that certainly would put us back on track of potentially starting to reduce the lockdown, getting back to normal life sometime in May. And that certainly would be on the more optimistic side in terms of estimates. So I see that as a huge positive in understanding the impact of all of this. So we have some new data to show you on the impact side. So first and foremost, the Fed's monetary policy we've seen improvements in the liquidity metrics. We've seen improvements in the investment grade bond markets as a result of this. So 10-year yields currently trading at about 78 basis points. It looks like we'll probably open up a little higher here today. That is a big positive, because a lot of the panic selling that we saw during the sell-off was due to the lack of liquidity in the treasury markets and in the fixed income markets. That liquidity, that seems to have resolved itself mostly. We've seen quite a few investment grade and even high yield grade bonds issue bonds over the last few days without any hiccups, which means that we're now back in a more of a functioning fixed income market. And as long as that stability is there, I don't think we're going to see another panic sell-off here in the equity markets. The credit card data, this is something we looked at last Tuesday. And what we now have is data up until the end of March. And we looked at some of this data last week. And again, none of this stuff in this particular range, I think, is surprising for people, seeing roughly almost anywhere from 100 to 60 to 70% decline in the airlines and entertainment sectors. Clothing and furniture and department stores also remain fairly weak. This is one of the sectors that I think we're going to see some surprises to the downside during earnings season, especially some of the clothing companies. Online electronics and grocery actually continue to show their strength. We were expecting that this would be more of a short-term gain, but as you can see, clearly, maybe people not spending going out to eat, going out to travel, they're spending it on online electronics, they're spending it on grocery. Grocery remains very strong. And general merchandise, health and beauty, home improvement, general retail, total retail, relatively strong. So, we had this decline here over a few days where we saw pretty massive declines of roughly about 40% decline in total spend. That has eased a little bit towards the end of March, down only 29%. So the question is whether or not we see this trend continue to improve, or if this is just a fluke of a one day and we continue to see 40-45% declines, because 40 to 45% declines in consumer spending is going to hurt, because 70% of our economy is consumer spending. So this is a data set that we're looking at very closely, because this really helps us measure the economic impact that we expect coronavirus to have on our economy, is the depth and, more importantly, the length of which this lasts for. So again, the timing on the peak of that coronavirus, very, very important indicator for us to look at to understand when we kind of get back to normal. So let's take a look at some of the sector and themes. So I'll actually start off by talking a little bit about liquidity. So for those of you, we've gotten a lot of questions over the last few weeks about our liquidity list. This is something we publish now. And, we talked about this on last Tuesday. We saw about 130 liquid symbols. That was actually the most that we've seen since the start of all of this. And then towards the end of last week, Wednesday, Thursday, Friday, as the market sold off, liquidity actually evaporated. On Friday, I think we only had about 90-something symbols that were what we would consider liquid. So we actually saw a regression in liquidity. But today, or yesterday, was the first day that we saw the recent all-time high. We had about 130 3 liquid symbols for trading. I expect this list to actually improve today, especially as we're about to open it a little higher. The liquidity in the fixed income markets are improving, so I expect the same improvements to see here in the options market. And this list is now sorted by liquidity. So the most liquid symbol, SPY, QQGLD, are at the very top, and then the least liquid symbols are at the very bottom. The implied volatility rank tells you how volatile a stock is compared to its recent history. The more volatile, the more red it is. The more green, the less volatile it is, and the upcoming earnings date. So with this list continuing to improve day by day, and this list growing, as you can see, there's going to be a lot more individual stocks here on this list, which means that we now have more opportunities to potentially try to pick individual names or stocks that we think are going to perform well for our trading. And I think that is the opportunity that many investors are seeking at the moment in terms of understanding exactly how to go about trading this market. So with that, what I want to do is I want to jump back to some of the sectors and themes that we're paying attention to. First and foremost, semiconductors. This still remains one of the strongest sectors in the market. We now expect a much faster recovery in this particular industry than any other industry at the moment. As you can see, consumer electronics remains one of the strongest sectors in the credit card spend data that we were showing you, and that's why we see this sector being one of the sectors that will actually recover the fastest. So most of the names in this particular space, I think people are familiar with: AMD, Intel, but AMD, back near its February highs. I think the stock, up about 11.5% when the markets were up 6% yesterday. So clearly one of the stronger stocks in the market. And what AMD, Intel, Nvidia all fall into this category. These are the stocks that are likely going to get back on their feet the quickest. Commercial real estate, commercial aerospace, sorry. We've been getting a lot of questions about Boeing, about the airlines, Delta, United, American, some questions regarding the domestic discount airlines. So the data currently shows that we've seen about a 95% decline in all airline traffic. So this is not a good number for this particular industry. And not only is this number terrible, it's actually continuing to get worse. So corporate travel is pretty much at zero. Leisure travel is still continuing to decline. So as long as that decline still continues to decline, we don't think it's time to venture into some of these names. And also, the path to recovery in this particular sector is one of the slowest that we're expecting. So we're expecting extremely slow recovery. We're talking 2021, late 2021, early 2022 for a lot of these airlines to even think about getting back to some form of normality. We see extended downside in 2020. We think 2021 is going to be a very tough time for these companies in the commercial aerospace space, and this includes the companies that build planes like Airbus, Boeing, the plane makers, suppliers like General Dynamics, Textron, and the airlines, the air leasing companies. It's a broad category here, and it covers a vast number of industries within the commercial aerospace sector. Boeing had a huge cancellation yesterday from an airline worth about $8 billion. So, the airplane makers, the suppliers to the airplanes, the airlines, these are all companies that at this point, until the decline in traffic stops and we start to see a resumption in airline travel. And if we look at China, they're still at about 40% capacity after opening up their lockdowns for quite a few weeks now. So, in cities like Shanghai, congestion and traffic is almost back to normal, but air travel is still at 40% normal. So this is, again, one of the sectors that we think is going to see one of the longest roads to recovery. We've been getting a lot of questions regarding discount retailers, so we want to take a look at some of them. And this is actually one of the bright spots that we see in the retail space. discount retailers. We talk about Dollar General on Options Action on Friday. This is one of the breakout stocks that I want to pay attention to because Dollar General did make a new 52-week high yesterday. Very, very few stocks are in this category of making a new 52-week high. Broke above that 165 level yesterday, so I think this is a stock to pay attention to. The thing about discount retailers is that they typically see a boost right after refund season. So, with tax refund season coming up, even though it's been extended out to July, the fact that stimulus checks are coming in, these are reasons why we think some of the discount retailers will benefit from this current environment of going into a recession. People who are more income sensitive with tax refunds and stimulus checks and going into recession, they're going to likely move towards some of the discount retailers than the full service retailers. Also, another interesting sector to look at are the car parts companies. The car parts retailers. So AutoZone, Advanced Auto Parts, those are stocks that, as automobile production grinds to a halt, and as we head into a recession, as a lot of people lose their jobs, they're unlikely going to go out there and buy brand new cars. They're more likely to fix up their existing cars. So AutoZone and Advanced Auto Parts is actually, I think, one of the opportunities that I see, because these stocks actually sold off fairly heavily. Yeah, I think they may have sold off a little more than perhaps where they should be, and I think there's some more upside in those particular names, especially going into earnings season for these two particular names. If you look at Advanced Auto Parts, AutoZone is a pretty expensive stock at 800 something bucks, but Advanced Auto Parts at $95, took a pretty big tumble here from February highs about 145 all the way down to 75. It's up 13% yesterday, when the markets are up a little over 6%. So I think this stock is going to continue to outperform going forward. It still has bearish trends. So again, this is where I think this stock oversold or overshot to the downside a little bit. And now you have some upside on these particular names, especially as we look at some of the automobile stocks and see that revenue on those stocks have basically ground to zero at this point. So definitely some of the stocks we're looking at. We're getting also a lot of questions on Disney. So we took a look at some of the media and streaming data. So first of all, what we see is a very steep decline in ad revenue for these particular names. So, and people have been asking us about Disney because Disney Plus downloads have been extremely strong in the app stores. So, that has led to, a lot of people saying, hey, I think Disney is going to outperform. But, when we look at these particular names, we've seen very steep ad revenue declines. We're continuing to see that. We think that's going to be a tough market in the next few months. And this is the case for Facebook, for Google, any firm that relies heavily on advertisement. We think that this is going to be a big challenge in 2020 to get back on their feet. Not as bad as the aerospace market, but as consumers pull back on spending, advertisers will pull back as well. You have a lot of small businesses that used to advertise on these platforms that are effectively going to go out of business or may not have the liquidity or the same marketing budgets going forward. So ad revenue spend, I think, is going to see a significant decline going into 2020. So the outlook here has dimmed quite a bit, on top of the fact that there has been no new content. There's been no content production whatsoever across the entire US. So these companies are going to take a bit of time to get back on their feet in terms of creating content. So this is one of the sectors that I'm not as bullish on. I know a lot of people are looking at Disney and they're saying, the stock is down. Let's see where Disney is trading right now. Disney's still around that $99 mark after, a peak of around 145. And, this certainly has the hallmarks of a bottoming formation, right? You kind of have a bit of a head and shoulders formation, and you might very well get a bump higher. But I think the bump higher is going to be relatively limited. So if you're going to buy Disney, if you're going to buy some call options on Disney, I would make sure that you consider taking profits relatively quickly on a name like this, because I do think the upside on something like this is somewhat limited. And lastly, home improvement. Some of the credit card data we were showing you before, home improvement is extremely strong. Basically seeing almost no decline in terms of spend. So, and this is really one of the times where I actually quite like Lowe's over Home Depot, because Lowe's sold off a little more heavily than Home Depot, going from 56 cut in half almost down to 30. It's now up to about 35, up 9% yesterday when the markets are up 6%. This is one of these sectors, this is one of the stocks that I think will have a pretty nice bounce higher, because as we head into earnings season, this reports earnings in 3 weeks. I think this is one of the stocks that's going to show pretty strong, not only guidance. Oh, whoops, sorry, wrong Lowe's. Sorry. This is one of the stocks that's going to show relatively strong guidance here going into earnings season. It's still below that $90 resistance level here. So, you have this $90 line in the sand. So I think that you might see a nice breakout here and maybe run back up to that 100, maybe even that 105 area here on a stock like Lowe's versus Home Depot. Very similar outlook here. Home Depot a little not as strong as Lowe's. As you can see, Lowe's was pushing that resistance level. Home Depot is still a bit below that 198, let's just call it the $200 resistance level. So now, this is definitely a sector that I'm paying attention to. Lowe's reports earnings here roughly a month and a half away. So you still have quite a bit of time, and I would expect that by May 20th, Lowe's would not only be able to give us a pretty good understanding of how they performed in Q1, which has a fair amount of the lockdown in there, but still just at the very tail end of Q1. But more importantly, much better guidance for Q2. So I'm expecting this stock to perform relatively well. So those are some of the themes that we're paying attention to right now. Like I said, liquidity is coming back. The markets, let's take a look at where we are. We're about 7 minutes away from the close. Wow, we're up to 274. So it certainly looks like we're going to open above 273, which is a major resistance level. Again, I'm curious to see how the market performs today. I'm curious to see how the numbers for coronavirus pan out today. Those are very important indicators for us to take a look at. So with that, I want to thank everyone for taking the time out here this morning. And I will try to answer a few questions if anyone has any questions or symbols you might want to take a look at here today. I wonder if the market conditions currently are conducive to writing cover calls or cash secured puts. Absolutely. I think this is one of the best times to consider selling put options on stocks that you want to purchase, especially as stability and liquidity comes back a little bit. You have, I think, a much stronger leg to use some of those strategies. I will say that, the market's up 10% in 2 days. From a timing perspective, selling puts may not be the best time. You generally want to wait for the markets to sell off a little bit to get into a short put. Cover calls, now I think is the best time when the markets are up 10%. You're going to have slightly smaller opportunities for another 10% move to the upside. So selling cover calls on stocks that you own makes a lot of sense in this particular environment. Can you please post a link to the liquidity list? So we post this link, it's trade.optionsplay.com/liquidity, which I will post into the chat window right now. Can we take a look at Apple? Sure, let's take a look at Apple. Apple at 262. I see this 265 level being a fairly major kind of resistance level. Looks like I think we'll probably open up above that level here today. So let's take a look. Yeah, we're opening around 270 right now. So very strong move here on some of these names. I will say that I'm a little weary of such strong movements, considering I don't think things have changed that drastically from Friday. So let's see how markets shake out today, because I think that's going to be very telling as to how we proceed going forward. What do you think about banking? Banking stocks certainly seem to have found a lot of stability. Whether you look at Bank of America, JPM, but these are still some of the weakest names. So I'm not as bullish on some of the banks at the moment. And this is purely because of yields. Yields are still very low. Banks predominantly make money on margin, or interest rather. So as long as interest rates stay low, I think these stocks they're not going to bounce back to the same degree that tech stocks may be bouncing back, that some of the home improvement stocks, some of the discount retailers, those are the ones that I would focus my attention on for a bounce, not the banking sector. Michael Morrow, you're very, very welcome. Thoughts on VXX? Will it continue to go down? I don't look at VXX very often, I'll be honest. But looking at the VIX, that certainly seems to be the case. VIX pulled back below 45, which is a pretty big line in the sand for VIX to be below. So pulling back below 45 has historically been a pretty good indicator that the previous peak was the market bottom. So pulling back below 45, I think, is significant, and I think VIX will likely continue moving lower, especially as stability comes back. But again, if the number of coronavirus cases continue to peak, then I would say, that kind of goes out the door. Again, as we do this, even though we start to see a little bit more optimism, a little bit more stability, things are still changing very, very rapidly. When we did this last Friday, things were very, very different than what we're doing here every Tuesday, this Tuesday. So we're continuing to monitor things very, very quickly and trying to get you guys the most up-to-date research so that you can make informed decisions as to where to place your trades. I don't know anything about EVZ, unfortunately. Would you suggest closing the Nike put spread? I think that, based on the market price action we've seen over the last couple of days, my bearish outlook on the market certainly has shifted, I will say, especially getting back above 273 on the S&P would be a very big milestone for the markets. And I think that would greatly shift my neutral to slightly bearish outlook on the markets. Again, this is also driven by the fact that we've seen this peak in the US in terms of number of cases. If that sticks, that would certainly be a very optimistic outlook for our ability to fight the coronavirus if we did peak here on April 4th. So that's really some of the data that I'm paying attention to. Thank you so much for everyone's thoughts here. With the quick running in the market, cover calls are nearing in the money. Should I sit tight or consider rolling up and out? So if you're near expiration, you absolutely should be rolling up and out. If you're still far away from expiration, I would hold on to it because you want to extract more yield, extract more extrinsic value from that cover call before you start to roll it. Would you trade Wayfair? Wayfair is not in that liquidity list, so I, at this point, would stay away from names outside of that liquidity list because, again, liquidity is still well from normal. It's still far from normal. 130 names is about a third of the list that we normally would see. Normally, this list is about 400 to 500 names, and even then, Wayfair usually doesn't make that list. So I'm not going to comment necessarily on Wayfair simply just because I wouldn't trade that from an options perspective. What to trade without having stocks? So that is a tough thing to trade right now, I will say. Selling credit spreads makes some sense here. As things return back to normality, selling put spreads on bullish stocks, selling call spreads on bearish stocks are great strategies to utilize. Do you think we overshoot in the short term and need to back and fill? I certainly believe that is a possibility that we overshoot in the near term, even to the upside, and then we need to come back and fill some gaps. That absolutely, I think, is going to happen. How possible that the market seems to be recovering the bull market status? There's no positive economic outlook in the short term. Well, I will say that the markets are always forward-looking. So the markets are always, they're not necessarily just looking at what the data currently shows. They're looking at what we expect to happen in the future. And certainly the market is telling us that they're fairly optimistic right now. So, markets are opening up above 273. Let's see where it trades today. and that's going to inform our decisions. So thank you so much for taking the time out here this morning. Again, I hope that you guys find this useful in helping you frame your outlook on the market, framing what symbols to pay attention to. The liquidity list is very, very important at the moment. You know, slowly getting better, but not quite there. So make sure that you pay attention to that list. So thank you so much. And I'll send you guys a recording here in a few minutes once we're done. Have a great day, and I hope you guys stay safe.